Hi, welcome to today's webinar for those are self-employed and small business owners that are abroad. I hope you enjoy it and find it informative and gives you a little bit more of a sense on how you report your business income when you do have a business abroad. So my name is Natalie Goldstein and I am the CEO of MyExpatTaxes. And what we'll talk about today is what are the different company types? What are the different types of, being self-employed, or if you have a limited liability company, what does that all mean and how does that translate to your US tax return? On top of that, if you are self-employed, what is the self-employment tax that you need to know about that you might potentially have to pay? And if you have a limited liability company, what are all these additional forms that you have to file? I'm sure you've probably heard of this dreaded Form 5471. Is this Form 5471 really that bad? Aside from that, we'll also just look at the overall common types of self-employment profiles. And I think that is probably the most interesting thing about being self-employed because being self-employed is kind of a blanket term. There's a lot of different types of self-employment. And this webinar will help you dig into what does that actually mean and what type of self-employment are you and what does that mean for your specific situation. So of course, after we get into, those details, we'll kind of reel you back and get back to the basics of, okay, well, now that you know a little bit more about the specifics of self-employment, how does that fit into the grand scheme of overall US tax reporting? What happens if you haven't been reporting in the past few years? Or if maybe you find out through this webinar that maybe you haven't been including all the forms you need to do, how you fix that. And then we'll jump into the live Q&A afterwards. So, like I said, there's a lot of different types of self-employment. It's always interesting when, you ask someone what do they do and they say, "Well, I'm self-employed." What does that mean? What does that actually mean? So you have a couple of different types that you see on the screen. Obviously, I'm probably not covering every single type out there, but these are the general types. So the first type is, probably the most common, which is a freelancer. That's someone that is operating in their own name and address. So for example, saying, I'm going to go start writing content for someone, or I'm going to maybe do, you know, some type of gig works, maybe work for Uber or Foodora or whatever, right? So that's general freelancers. You're just kind of doing, work on the side, or maybe it's even your main role, but you are operating in your own name with your own address. There's no separate entity, right? You didn't create a company. Now, of course, the next step to that is you did create a company, right? But you haven't gone so far as to have limited liability, which means you've created a company. However, that company is you. Maybe you are self-employed and you're not operating under your own name, but maybe you have a different company name. Maybe you even have a company address. However, when you're reporting your own local taxes, that company and it's the same, right? There's no separation between you and the company. So basically, what that effectively means is if something happens in the business, right? So if you are working as a self-employed person and something happens and, you know, perhaps someone decides to sue your company or sue your business, that would actually impact you personally because there's no limited liability. You are fully liable for what you do as a business. So that's the next level, right? Now we get further because maybe you say, well, I don't want to have that type of liability. I don't want to have full liability. So what I do, as a self-employed person, I don't want that to impact my personal life. I don't want to have, perhaps any type of financial issues that happen in the business impact my personal home or things like that. That's when normally people will create some type of entity with limited liability, right? It's in the name that you have limited liability. So normally that means that you're only liable for the amount of money that is actually inside of the company, but you're not liable for more. So in this case, the question is, did you incorporate this company in the US or did you incorporate outside of the US? Because you have to then incorporate a type of company. So if you incorporate a limited liability in the US, it's normally an LLC. That's the easiest, right? Limited liability corporation. It's literally in the name, limited liability. And obviously you could go further to incorporate an actual incorporation, right? In Inc. Most people will probably stick to an LLC for the most part at this stage. So this is for small business owners and not necessarily, the Microsofts and Googles of the world. Now, if you decide to incorporate your company outside of the US, right, that is basically, okay, you have maybe in Austria and Germany a GmbH. I'm not going to tell you exactly what a GmbH means in German because I'm going to say it wrong, but the direct translation is basically, again, a type of company with limited liability. In the UK, that would be a limited. I think it's also in Singapore also called a limited. Really, you have to think, okay, what type of way are you doing your business? Are you doing your business as yourself and you're fully liable? Or do you have an entity that's set up and then you're doing business through that entity? And if you do have that option, is that incorporated in the US or outside the US? So again, just kind of keep that in the back of your mind. There's still a couple other self-employment types to get through. And that's why, again, I say it is such a blanket term to say you're self-employed. So then you have partnerships, right? You might have a partnership in the US. You might have a partnership that's formed outside the US. A partnership is generally two people that come together to do business. And generally, there is still full liability. The only thing is if you have a partnership, it's not just you anymore, right? It's you with other people. And so in this case, it's still reported differently on a US tax return. We get into a little bit more specific types in the second row that you see on the screen. So a foreign disregarded entity is for those that, let's put it this way, you kind of know what you're already doing with your US taxes. Best example I can give you is you have a limited liability company outside the US. It's just you're 100% share owner, and then you have elected to disregard that entity and rather report the income directly on your own tax return as a Schedule C filer. So again, you have to kind of know what you're doing to be in this bucket. So if you don't know or you don't understand what I just said, you're probably not in this bucket. So you can just ignore that, right? The next part I mentioned is, again, if you incorporate a company inside the US, it's probably a single member LLC. If you're incorporating a company in the US with limited liability with multiple members, then you're going to be filing a corporate tax return in the US. But if you only have one person, so it's only you and you incorporate an LLC, that can technically still be seen as a disregarded entity and reported on your Schedule C. So that is a little bit easier. There's also a more kind of, I think, buzzy word about corporations, which is the S Corp in the US. And people say, oh, this S Corp is this great entity because what you can do is basically get away from paying self-employment tax. So it is there. If you're in an S Corp, if you have an S Corp, you probably already know what you're doing. So just, again, if you're not sure, ignore it. It's not that common. And the last one is a statutory employee. And that's normally someone that has a W-2, but maybe they're like an insurance agent. And then you'll have this box checked on your W-2 that says you are a statutory employee, which means that you are employee, but you're technically operating as self-employed. So you still report your income expenses on Schedule C. That's a lot, I know. So let me bring it back to what's actually important for you. So as you sit there and you're thinking, how do I file my self-employment income on a US tax return? Let's just kind of focus on the main points. The main point is, how do you operate? Are you a freelancer that is fully liable for the actions of your business? Or do you have a limited liability entity that is shielding you from the business, right? From the liability part of the business. And again, it's all about, are you operating kind of as a private person or are you operating as a business? And if something were to happen in that business, your personal assets would not be liable for, anything that may happen, right? So once you figure that out, right, and I think it's pretty simple because if you have a limited liability entity, you should probably be aware of it because you will have literally a company that has been incorporated with you as a shareholder. But that's the separation. If you're a freelancer or even if you're perhaps a single member LLC, you will generally report your income and expenses on your US tax return on Schedule C, potentially be open to self-employment tax, but there's no other special forms to file. Now, if you have a limited liability company that's formed outside the US, you're looking at potentially filing 5471. And if you have a partnership that's formed outside the US, you might be looking at filing Form 8865. So let's go a little bit more the route of you're a freelancer, you don't have a limited liability corporation. Again, this is the majority of self-employed people, right? So if that's the case, like I mentioned, what you do is you report your income and your expenses on Schedule C on your US tax return, right? So you would attach Schedule C and then you calculate your self-employment net profit, and then that is taxable at ordinary income tax rates. What the shocker usually is that you might also be liable for self-employment tax. Self-employment tax is a Social Security and Medicare tax that is on your net profit. It's about 15.3% on any net profit over $400. And again, if you think about who needs to file a US tax return, one of the exceptions, even if you don't meet the filing thresholds for your filing status, is if you have over $400 of self-employment net profit, you still have to file a US tax return. And the reason for that is, again, you may be liable for self-employment tax. So how do you get out of it, right? So if you are a self-employed person abroad, if you're a freelancer abroad, you probably are paying this type of self-employment tax in your local country, because this is not anything new, right? If you are self-employed, you normally have to pay some additional taxes to cover, health insurance, pension benefits, etc. And it kind of rolls up into this whole self-employment tax. And I know in Austria that we're liable for self-employment tax. So if I am a US citizen working in Austria as a self-employed person and I have to pay self-employment tax to Austria, and then now you're telling me I also have to pay 15.3% self-employment tax to the US, honestly, you probably won't be seeing too much money afterwards, right? So how do we get out of this? And the way you get out of this is through the Totalization Treaty. There are about 30 totalization treaties that exist, and this is a treaty with the US and your local country that says you don't have to pay self-employment tax to both countries. You only have to pay it to one country. And if you don't have a totalization treaty in place, then you're going to have to pay self-employment tax to both countries. And it's not necessarily bad, but it's something you have to plan for, right? Because again, that's a big chunk of income that you lose to taxes, right? Even if you might see it later, something to plan for. So if you end up paying self-employment tax to the US, just know that you do get credit for it. So it's not all loss. You will get credit towards your Social Security benefits account so that one day later you can draw from US Social Security benefits. However, yes, the immediate having to pay the 15.3%, a little tough, right? So if you're in a country with a totalization treaty, what you can do is essentially claim it and say, no, I'm only gonna pay self-employment tax to one country, mostly being your local residency country, right? I do wanna call out one exception there. While the majority of them work in that way that you can just choose basically your residence country to pay self-employment tax in, Italy is different. If you are a self-employed person in Italy, we'll get into it, but basically, if you're not an Italian citizen, then you'll always be paying US self-employment tax. But the best thing about all of this is there is a way to only pay one country's self-employment taxes, Social Security taxes. However, to claim it is not the most straightforward thing on your US tax return, as how can it be? It's a US tax return. It's never that straightforward. So what you end up doing is you report, your income expenses, and then you have your net self-employment profit. Now, instead of filing Schedule SE for your self-employment tax, what you do is you then claim the totalization treaty. So you can claim it by adding a statement. You can claim it by filing 8833, which is what we would recommend. And then normally what the IRS actually instructs you to do is to attach a certificate of coverage and paper mail your tax return. Nobody wants to paper mail their tax return. So while this is the general way and the kind of recommended way from the IRS to prevent any, post-filing questions, you can opt to e-file your return and then keep your certificate of coverage handy. Now, a certificate of coverage is not always the easiest thing to get. This is a certificate that you would get from your local country that says you are a resident here and you are paying into the Social Security system in that resident country. So you're exempt from, paying in the US. Again, not the easiest thing to get. Some countries issue it a little bit easier, like the UK. If you don't have that, I would recommend to have your local tax return handy that shows that you are reporting your self-employment income to that country and paying the applicable, Social Security taxes. So again, if you're in a country and there is a totalization treaty, but you're not actually reporting your self-employment income there, you cannot use the totalization treaty. This is only for if you're really, registered in a different country, you're registered as self-employed, and you're paying relevant Social Security taxes in a different country, that you can tell the US, hey, I'm exempt from paying in the US because I'm paying locally. If you do this, if you e-file with us, certificate of coverage, very rarely the IRS will ask for that certificate of coverage. And I think this happens, maybe we file thousands and thousands and thousands of tax returns every year. I think maybe we see it once or twice every year that the IRS will ask someone. So it's kind of like this random, did you win the IRS lottery of getting, a question? If so, like I said, you just send them the certificate of coverage, or if you don't have it, your local tax return, and that will normally just solve the issue. That is self-employment tax. Basically, 15.3% plan for it. If you are in a country with the totalization treaty, and we'll show the countries on the next slide with totalization treaties, then you could potentially exempt yourself from paying the 15.3% tax. And if not, just plan that you will pay it, but it's not all loss, because you can earn up to 4 credits per year in Social Security credits. And if you have 40 credits, so 10 years of working, you will be eligible one day for US Social Security benefits. So not all loss, planning for the future, but yeah, stings a little bit when you have to pay the tax upfront. As you see on the screen, there are a lot of totalization treaties. They are continuously adding to them. So just because you don't see your country now doesn't mean that, maybe 5 years from now, it won't be there. But I do want to call out, some kind of more important countries that are not there that can shock people. So even though Australia has a totalization treaty, New Zealand doesn't. And so I know this shocks a lot of folks because generally you would think that certain countries should have some type of relationship with the US, but New Zealand unfortunately does not have a totalization treaty. So in that country, definitely expect to pay this 15.3 self-employment tax. Like I mentioned earlier, Italy is kind of different. I don't know why. If you're a dual citizen, right, Italian and US, you can choose to pay in Italy. If you're a US citizen and you're self-employed in Italy, you're still paying self-employment tax to the US, but not to Italy. And this can be really confusing because your local Italian tax consultant may not know that. And so what we normally get is people that are living in Italy that are not dual citizens and they're paying Italian self-employment taxes, but then they end up having to pay US, and then for them to have to go back and explain to their Italian, local tax consultant that they're US citizens, so they have this totalization treaty, is a little bit of a nightmare. Fortunately, at least on MyExpatTaxes, we have this all automated. So we know, based on your citizenship, based on what country you're working in, if you're eligible or not eligible to pay, self-employment tax or to claim a totalization treaty. Totalization treaties are different from the normal US tax treaties. There are over 60 US tax treaties. You can see there's a lot less totalization treaties. Sometimes we just saw, that a tax treaty can get revoked. So the tax treaty with Hungary just got revoked and, it's no longer valid and or existing. However, the totalization treaty for that country still exists. So that was for people that, are freelancers. Kind of the main thing you have to watch out for is self-employment tax. What happens if you have this limited liability corporation? Well, generally you don't have to look out for self-employment tax. However, you might have to file Form 5471. So Form 5471 is a complex tax form. It's a more complex tax form that you would include in your US tax return. And it is for officers, directors, and shareholders in certain foreign corporations. And if you don't file this form, you can face up to a $10,000 penalty per year for every late filing of 5471. So it is a very serious form, so to say. If you need to include it, you have to include it. We haven't necessarily seen the IRS issue actual bills for this $10,000. However, there is a form that is similar to it, which is 3520, and we've definitely seen the IRS shooting out those penalties like nothing. So again, nothing to take too lightly. Now, do you have to file this form? It's not that straightforward. If you just read the instructions for 5471, you're probably going to get very lost. So we try to summarize it. Just keep in mind that as we're summarizing it here, every situation is unique, right? We can only give you this general kind of navigating way to go. I do encourage you to just go on MyExpatTaxes. Even before you pay, there is a whole section that asks you about your shareholding, right? So how much, how much interest do you own in a foreign corporation? If you have relatives in that foreign corporation, if you own shares with a spouse, if they're a US citizen spouse, if they're a non-resident alien spouse, et cetera, to help you get a more personalized kind of yes or no, you need to file this form. This is more blanket, generally how it works information. So just keep that in mind. So do you, or you with your spouse, or you with other family members, right? Do you altogether own more than 50% of a foreign limited liability corporation? If the answer is yes, you're filing Form 5471 pretty much every single year. Do you or your spouse or your family members own more than 10%, and there were increases or decreases in the shareholding for the US citizens at any point in the year? Then yes, you generally have to file Form 5471 in the year where there were shareholding changes. So the last one is, are you a director or officer of a limited liability corporation that's incorporated abroad? And, let's say that there is for sure a 5471 filing requirement because it's a controlled foreign corporation, aka more than 50% is owned by US citizens, even if you might not be the one that owns more than 50%. If your other US shareholders are not filing Form 5471, you have to file it on behalf of them. So when we look at Form 5471, to kind of summarize it, is the first question is the company a controlled foreign corporation? A controlled foreign corporation is an IRS term. And this means that more than half of the company, so over 50% of the company, is owned by US citizens or persons. So basically that's your first check. Is the company over 50% owned by US citizens? If the answer is yes, and it's a controlled foreign corporation, then that company will need to file Form 5471 every single year. Of course, the company itself doesn't file the form. So you as a US shareholder, you have to figure out, okay, do you have to file it? Maybe another US shareholder has to file, etc. It only needs to be filed once by one US shareholder. The second part that might trigger a Form 5471 filing requirement is even if the company is not a controlled foreign corporation, so it's not over 50% owned by US citizens or persons, do you control over 50% of the company? So an example here is generally, it's really two ways it goes. Either you as a US person, you own over 50%, so you control the company and it is a controlled foreign corporation. So that's probably the most common people that just open a foreign corporation and it's 100% owned by them. So this would be a controlled foreign corporation and they control the company. The other option is, say you have a non-US citizen spouse and you and your spouse open up a foreign corporation, and you own 50% and your spouse owns 50%. So it's not a controlled foreign corporation because it's not over 50% owned by a US citizen because, the other shareholder is not a US citizen. However, you, through constructive ownership, control the company. So even if it's not a controlled foreign corporation, you technically control over 50% of the company because you have your 50% of shares, but because your spouse is the other shareholder, you constructively own their 50% as well because you can basically influence their decision, right? That's how it works. So constructive ownership then also works in terms of parents or children or grandchildren. It does not work for siblings because the IRS understands that you cannot control your siblings, but you can probably control the actions of parents and children. But siblings don't count in this situation. So just a little funny tidbit there. So if the company is a controlled foreign corporation, over 50% owned by US citizens or persons, have to file 5471 every single year. If you control the company, whether directly or indirectly through constructive ownership, have to file Form 5471 every single year. If none of those are true, but you do own over 10% of the company, you may still have to file Form 5471 in the years that there are shareholding changes. Not every single year, but in the year that there are shareholding changes. So just keep that one in mind. And of course, as I said, if you know that there has to be a form filed, but the other shareholders are not doing it, then you got to step up and do it yourself. So that was a lot of information about just if you need to file Form 5471. Now let's get into what actually happens when you file Form 5471. What is the actual cost of this form, of having a limited liability company abroad? So the first part is obviously the US tax preparation fees. So I'm sorry, but there is no do-it-yourself tax software out there in the world that will just, include it in the price. Just because it is a very complex form. We need financial statements from you in order to create the forms. We then ask a lot of questions about, any distributions you take out, who owns shares, et cetera, et cetera. So with MyExpatTaxes, we do try to make it as affordable as possible. So if you're in our premium plan, you can add on this form at 299 euros. And keep in mind, if you're doing this form with pretty much any other tax service, you're looking at a bill of starting of, $500 to upwards of $1,000, $2,000 just for the form itself, right? So we really try our best to make it more affordable. Form 5471, people get a little bit confused because they think it's just that form. It's not. It's Form 5471 and all related schedules and forms. So Form 5471 is already maybe 3 or 4 pages long, right? And it goes down to Schedule I believe. However, what you also need is you need a separate Schedule C, and then basically all the schedules from, there from E to R. There's a lot of different schedules, Schedule J, Schedule P, Schedule M, blah, 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 blah. So based on what kind of category of filer you are, a lot of different forms to add in. Now, on top of that, if it is a controlled foreign corporation, right, and you're subject to GILTI taxation, you also have to include Form 8992 and its related schedule. And if it's a company that was just incorporated or, basically you gave property to the company to start it, whatever, you might also need Form 926. So when you are looking for tax preparation fees, I really encourage you to understand the full scope of that price, because it is common that US tax firms will charge you for Form 5471 and they'll give you like an initial price. And then they'll charge you for the additional forms. They'll charge you for the additional schedules. They'll charge you for the additional form, GILTI taxation, 8992, etc. So it can be a lot of hidden costs. Again, with MyExpatTaxes, if you file with us, it's in the premium plan. It's 299 euros per company, so to say. So per Form 5471 plus all related schedules and forms. There is no further hidden price in there. So that's just the cost for the preparation. What's the actual taxation? Because, after you prepare, you might actually owe taxes as well. In the best case, there's basically 2 best case scenarios. So if you don't have a controlled foreign corporation, so not over 50% of the company is owned by US citizens. So again, this can be the case where you own 50% and your non-US citizen spouse owns 50%, right? And it's not actually a controlled foreign corporation. There's no taxation of your net profit. The US cannot tax that company's net profit. You obviously will have to report any salary you receive, any dividends you receive, right? So any payments made from the company to you on your US tax return. However, the net profit of the company cannot be taxed in the year that there's net profit if it's not a controlled foreign corporation. If it is a controlled foreign corporation, so it is over 50% owned by US citizens, your best case scenario is probably the GILTI high tax exclusion, which means that you pay at least 18.9 or more foreign corporate tax rates on your net profit, meaning that you've basically paid enough corporate taxes where your company is incorporated that you don't have to pay any further income taxes on your US tax return. So again, this is the GILTI high tax exclusion, and this basically means that, okay, even if there's a net profit, it's not taxable. So this is for those that are paying 18.9% or higher of corporate tax rates. Worst case, if you are not paying enough corporate taxes and you have a controlled foreign corporation, basically what you will get is you're going to have that net profit of the company taxed at ordinary income tax rates on your US tax return. and that you can't necessarily use a foreign tax credit on. So it can add up. So an example is in Singapore. In Singapore, you don't have that high of a corporate income tax rate. So what you would probably think is, okay, if I have a salary or if I have a dividend, yeah, of course that's taxable on my US tax return. But what actually is the truth is, if you own that company, it's a controlled foreign corporation, say you have a net profit, so you don't distribute the income from the company, a net profit of 50,000 US dollars. Guess what? Even if you didn't pay that to yourself yet and it's still sitting inside the company, the US will consider that taxable income in that year. What you can do in this case is there is another election you can make, a Section 962 election. It's not on the slide, but you can make this. And in this case, you would basically reclass your foreign company as a domestic company. And then in that case, you would be able to take up to 80% of foreign tax credits, corporate foreign tax credits. For simplicity's sakes, we don't get into it too much, but that is something you have to understand, that if you do have a controlled foreign corporation, your net profit might be taxable even if it's not distributed. And so you have to plan accordingly, especially if you are not paying 18.9% corporate taxes where you currently have your company. So in this case, what we would recommend is normally maybe you should pull out more in salary because you can use the foreign earned income exclusion against that, right? Or, something along that. It's a lot to think about, and this is again why you'll probably never see Form 5471 in a purely do-it-yourself mode, because when we file Form 5471 for our clients, there's really a lot to think about. So first we need your financial statements, and then once we look at what your corporate tax rate is, we'll figure out, okay, how much US tax are you actually liable for, and how can we basically minimize that either through the GILTI high tax exclusion or Section 962 election, etc., etc. So what happens if you are subject to GILTI taxation? Is that the end of the story? No, there's always some tips and tricks, not tricks, but really tips that you can use to lower your GILTI taxation. And that's why it's really important to work with, people that understand Form 5471 and how to get you the best situation possible. And at MyExpatTaxes, I can't even count. I don't even know how many Form 5471s we've done and how many situations we've seen. But basically, here are, the high level tips. So you can't use the foreign earned income exclusion or foreign tax credit on GILTI taxation. So you can't use it on the net profit of the company, but you can use it on any salary paid out to the shareholder. So in our other example with Singapore, maybe you paid out yourself an additional 50K of salary from your company, so your net profit is zero. You still get the same amount of money, but this is now, the $50,000 you can use the foreign earned income exclusion, and then you might not owe any US tax. Whereas if you didn't distribute it as a salary and you just kept it as net profit and it's taxable as GILTI, this is then subject to your ordinary income tax rates with really not much more you can do. You can also use foreign tax credit on dividends paid out. So you can't use the foreign earned income exclusion, but you can use foreign tax credit on dividends. Just keep in mind that obviously dividends come after net profit, so it's not going to really impact how your net profit and GILTI taxation works. As I mentioned already, GILTI high tax exclusion is, if it works for you and you're eligible, it's the way to go. This just is for people that pay more than 90% of the current US corporate tax rate. So 90% of 21% is how we get to the 18.9% figure. And then, of course, I kind of alluded to it, is this Section 962 election. You can do that. And what you will basically do is elect your company to be a domestic company, and then you can then claim some portion of your foreign tax credits that you pay at the company level. It doesn't always make sense, so it's something that really has to kind of be modeled and looked at. However, it is an option. Okay, here we come to, again, a little bit of an overview of everything I talked about. I have to say, for this webinar, we really got into the details. Normally, I try to not put you there, but if you are self-employed, you have to know what you're up against. It's different. It's a different playing field, right? So again, if you're a digital nomad and you're a freelancer, you're not really registered anywhere, you're, living your best life, working in different countries, hopping around, you're probably using foreign earned income exclusion. You will most likely be subject to self-employment tax because you probably cannot get out of it. Expect to pay 15.3% of your net profit in taxes every single year. If you're a self-employed person abroad and you're registered in a country, you're staying still in a country, that's where you live, that's where you work, you can use foreign earned income exclusion or foreign tax credit because you're probably paying local foreign taxes. And if you're paying local foreign taxes, if there is a totalization treaty in place, you can probably claim the totalization treaty, which means that you will most likely owe zero on your US tax return. If you are a business owner, so you actually have a limited liability corporation that's incorporated outside of the US, if you have a single member LLC incorporated inside the US, you are basically just seen as a normal freelancer, probably subject to self-employment tax. But if you have a limited liability corporation incorporated outside the US, you can basically use foreign earned income exclusion or foreign tax credit on any salary that you pay yourself, right, from the company. If you have dividends, you can only use foreign tax credit. And if you have, if the company is more than 50% owned by US citizens, expect that there may be GILTI taxation if you're not paying at least 18.9% of a corporate tax rate where your company is incorporated. However, the good news is there is no self-employment tax. So at least there's a silver lining. So that was everything about, okay, that's not everything, but that was a lot of information about being self-employed. Now let's reel this back just to the basics. Who needs to file a US tax return? So all US citizens, all US green card holders, also obviously if you are someone that's living in the US for a long period of time, you also have to file one. But US citizens, US green card holders, you have to file a tax return no matter where you live, right? If you meet the filing thresholds that you see on the screen, again, a couple call outs. If you're married filing separately, such as someone that is maybe married to a non-US citizen, you're probably filing if you have more than $5. Just the way it is. I don't know why they did that, but it's been like that since 2018. Now, again, like I mentioned, if you're self-employed, you do have to file a US tax return, even if you don't meet the filing thresholds, if you have a net profit of over $400, and that's because of this potential self-employment tax. If you have been listening to what I said, and now you're thinking, oh gosh, I didn't really do my taxes right. So maybe you have a limited liability corporation that you incorporated and you never filed 5471. Don't freak out. You're not going to be billed for, tens of thousands of dollars tomorrow. So even if you've been filing your US taxes every single year, however you forgot Form 5471, don't worry, because in the streamlining instructions, it says you can actually use it to also amend your prior tax return. So if you've been missing some high penalty forms like 5471, 3250, or 8938, etc., you can amend the prior 3-year tax returns and include Form 5471. So don't worry too much. And I do want to say one thing, because normally streamlining is only the 3 back years. So you only do the 3 back years, you do your current year tax return, then you do 6 back years of FBAR and your current year FBAR. If you do have a limited liability corporation that is over 50% owned by US citizens, so it's a controlled foreign corporation, if this was incorporated before 2018 and you did have a positive amount of retained earnings as of December 31st, 2017, I am so sorry, but you do actually have to file all the way back to 2017 because of this one-time transition tax. So I just put it out there that if this is your situation, do expect that you will have to streamline, but you do have to streamline all the way back to 2017. So you cannot use the normal streamlining procedure that's only back to 2021. With that being said, streamlining is not all bad because this is the last chance for you to claim the final stimulus payment that was made on 2021 tax returns. And that was $1,400 per taxpayer and per dependent. So if you have not filed your taxes yet, whether you need 5471, whether or not you're self-employed, if you haven't filed your 2021 tax return, please do so ASAP. And when I mean ASAP, I mean ASAP. So please do that before June 15th of 2025 if you want to see that $1,400 refund. It's the last call. Otherwise, that money no longer available to you. So streamlining, something to definitely do. if you've been missing high penalty forms, or if you just haven't been filing and you need to get caught up, because a lot of people will actually get refunds thanks to the stimulus payments, thanks to refundable credits on their US tax returns. So if you need to streamline, do it sooner than later. Final slide, just, as we close out, you have to file a tax return. When do you have to do it? So you always need to generally pay your taxes by April 15th, because that's the payment deadline. That's a filing deadline for those that are in the US. It's also the payment deadline for everyone else in the world. So if you think you owe taxes, April 15th. If you don't think you owe taxes, or you don't owe taxes because you file every single year and you never owe taxes, you can wait till the June 15th deadline. This year it is June 16th, just because June 15th falls on a Sunday, but June 15th, June 16th, make sure to file by then. If you perhaps need to file this Form 5471 and you do not have your financial statements for the company, and they're not ready, and they won't be ready by June 15th, what we recommend is file an extension to October 15th. You have to do this by the June 15th deadline, but file an extension so that your 5471 is not late. Because if it's late, potential $10,000 penalty. Of course, if it's late, there are ways that we can add a reasonable cost statement, which we'll do for you at MyExpatTaxes, etc. But try not to be late. And of course, if it's October 15th and you still don't have your financial statements, or, we just ran too close against the clock, what we then recommend is one final extension to December 15th so that you can get all your ducks in a row and make sure that you are compliant. Obviously, if you haven't been filing your taxes, as I said, please do it ASAP. June 15th, 2025. After that, you will not ever see that final stimulus payment from 2021. Thank you so much for enduring all of that tax information. I know it was a lot. Like I said, this webinar is probably the heaviest hitting, so to say, because there's a lot to know if you are self-employed. So I hope that you got the information you were looking for. And if not, please join us for the live Q&A, and we're always here for you. If we don't get to your questions, make sure to join our Facebook group. Make sure to email us at team@myexpattaxes.com. We know that taxes are difficult, especially if you are, a business owner. So if you need help, we are here for you, no matter how complex your situation is. If you are a freelancer and self-employed, you can even use our base plan. But if you have, a little bit more of a complex situation with a limited liability corporation abroad, make sure to use our premium plan. And really, whatever your situation is, we will try to be there for you to help make it as smooth as possible. Thank you for tuning in.